Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two highly ranked consumer tech stocks to consider for longer term investors who maybe buy now and consider holding for a pretty long time. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two highly ranked consumer tech stocks to consider buying, I want to take just a quick broader look at the market, which is just helpful for understanding why you might want to buy these two stocks. And it's always good to know what's going on in the broader context of things. So we saw that August marked another pretty strong month for stocks with all three major U.S. indexes finishing higher. The Dow was up 1.2%, the NASDAQ was up about 4%, and the S&P 500 was up about 3%. That was the benchmark index's seventh straight monthly climb, and last month marked its best showing since April. Labor Day then traditionally marks the unofficial end to the summer, with volumes set to return to more normal levels, but we haven't seen those volumes return just yet. And the holiday shortened week last week actually marked the S&P 500's worst week since June, with the S&P 500 down about 1.7% and the Dow slipped about 2.2% last week, while the NASDAQ dipped about 1.6% for its worst showing since July. In fact, the S&P 500 posted its fifth consecutive down day last Friday for its longest losing streak since February. So a bit of a slow start to the post-summer months for the stock market. The latest jobs report also showed that the U.S. hiring has slowed pretty sharply in August as the Delta variant has slowly hampered the economic recovery at the moment. There are some Wall Street analysts think that the U.S. economic comeback may have already peaked following what was blockbuster second quarter earnings in a massive run-up in growth in the spring and summer. That said, we could also get more of a pullback as traders and analysts have been calling for a pullback and maybe even a correction since the last mid-July downturn was wiped out nearly overnight. Still, despite all of that and some recent jitters and Delta variant worries, stocks remain close to their record highs, and there could be a relatively bullish setup for the fall and the rest of the year, with Fed Chairman Jerome Powell maintaining his relatively dovish stance on interest rates despite concerns about rising prices. On top of that, the overall earnings picture remains really strong, even though we've seen some positive revisions slow down recently. So with that in mind, we'll look at some of the earnings picture before we jump into these two stocks. So as we mentioned, Q2 earnings were massively impressive, but with that in mind, the Delta variant has seemingly caused CEOs and executives to be a little more cautious about giving their guidance and improving their guidance for Q3. So we've seen if we look back in early January, our Q3 estimates for growth for the earnings for S&P 500 was at 13.5%. That quickly surged all the way up to about 25% by the end of July. So it jumped from about 13.5% all the way up to 25% as the outlook for the economy just started to boom. But since the end of July, those positive revisions have slowed down significantly. And over the last couple of weeks, we've stagnated around 26% growth we're calling for in Q3 for Zacks estimates. So still impressive growth, but the big jump in positive revisions to the upside has slowed down. As we mentioned, some of that is due to the slowing economy, supply chain setbacks, Delta variant worries. That said, the margins picture, which is kind of what Powell is talking about in the sense that he's saying that rising prices are going to be transitory short term. So for annual S&P 500 margins, we're calling for about 12.7% margins this year, and then climbing up to 13.1% in 2022, and then all the way up to 13.7% in 2023, which would be 3 straight years of by far the strongest margins on record for the S&P 500. So that is a positive sign. And then in terms of annual earnings and revenue growth for the S&P 500, we're calling for about 43% growth, obviously against an easier to compare period last year of a 13% decline, but still impressive growth nonetheless. And we're calling for historic earnings and then about 13% revenue growth. And then on top of that, we're calling for another 9.4% growth next year, 7% revenue growth, and then another 10% growth in 2023 and another 5% revenue growth. So even with this blockbuster year in 2021, we're calling for more growth in 2022 and 2023, which is another reason to be bullish for the longer term. And so, as I mentioned, in terms of actual quarterly earnings, Q1 was the previous record, and then Q2 blew that out of the water, pulling in, with the S&P 500 pulling in $473.5 billion in total. And then we're actually expected to get above that blowout historic number next year in 2022. So we're calling for slightly higher earnings above that historic figure in Q2 of 2022. So despite these near-term negatives and some jitters in the market, the longer-term outlook remains strong with the earnings rates or interest rates and our broader earnings picture that shows longer-term growth. So with this in mind, we're going to take a look at two of these highly ranked consumer-focused tech stocks to consider buying. And the first one we're going to look at is Garmin, which trades in the ticker GRMN. And the company really provides exposure from everything from smartwatches to the future, which could include flying taxis. So Garmin's offerings Garmin itself might have become more of a household name in the US and elsewhere for its in-car navigation systems. But the company is far more diverse than that, which is obviously great considering that many people use their smartphones to find their way around in their cars or on their bike or however they're getting around. Garmin also sells everything from fitness wearables and smartwatches, which have really grown in popularity amid competition from Apple and others. In fact, fitness was its largest top-line contributor last quarter. The Switzerland headquartered company also sells high-end fish finders, advanced radar systems for boats and airplanes, and much more. And as I teased sort of at the top, Garmin in February landed an agreement with Joby Aviation for tech to help create what they consider scalable air taxi services. Obviously, this is a longer-term play, but the company is clearly very diverse, ranging, as I said, from smartwatches all the way to advanced radar systems for airplanes. Garmin's 2020 revenue climbed 11% to about $4.2 billion. This came on top of over 12% growth in 2019 and 7% growth in 2018. So steady growth on the top line in the last several years for Garmin. The firm then crushed our Q2 estimates with revenue up a whopping 53%, with the company seeing double-digit growth in all of its segments. Meanwhile, its adjusted earnings climbed 85% as well. So the company then raised its full-year guidance when it reported those results in late July. And Zacks estimates are now calling for its fiscal 2021 sales to climb 18% to just around $5 billion, with 2022 set to pop another 8%. So some solid growth on top of what has been strong growth in the last several years. Meanwhile, its adjusted earnings are expected to climb by 9% this year and then 13% in 2022. The company has also crushed our bottom line estimates by an average of about 40% in the trailing 4 periods. And as we mentioned, the company raised its guidance and it's seen its earnings revisions trend higher in the last couple months. So its positive EPS revisions help it land a Zacks rank number 1 strong buy at the moment. It's also part of a industry that sits in the top 23% of over 250 Zacks industries at the moment. And the stock's been on a pretty strong run. So it's up 43% in 2021 to outpace the Zacks tech sector's 25% climb. This outperformance extends over the past 5 years as well, with the stock up around 265% compared to the broader tech space's 185% climb. At the moment, the stock is trading at about $171 a share, which puts it about 5% below its recent records. The run has stretched its valuation a bit, but it trades right in line with the broader tech space at around 28 times forward 12-month earnings at the moment. And its dividend is yielding about 1.6% at the moment, which easily tops the 10-year U.S. Treasury, which sits at about 1.3%, and the S&P 500, which sits at about 1.25%. So with a dividend yield of 1.6, rather impressive, especially considering that the stock has been on a really strong run over the last 5 years, outpacing the tech sector as a whole, and up 43% in 2021. And despite trading about 5% below its recent records, the pullback has pushed it near neutral RSI levels. So that could see the stock start to rebound relatively soon. It's sitting, neutral RSI levels are 50. It's sitting at around 53 at the moment. It also boasts an impressive balance sheet with no debt on its books at the moment. And in the second quarter, the company generated approximately 120 million in free cash flow. And the company ended the quarter with cash and marketable securities of approximately 3.2 billion. So really strong balance sheet to go along with all of these other positives for Garmin. So investors with longer term horizons really might want to consider Garmin as a stable dividend paying tech stock that's exposed to lots of different growth industries on the consumer focused tech side, and all the way up to things that seem like something out of a sci-fi movie such as flying taxis. So now we're going to move on to another consumer-focused tech standout that obviously isn't, it's not as futuristic sounding as some of Garmin's plays, but it is still in a booming consumer-focused tech market that plans to expand for years to come. And that is Sonos. It trades under the ticker SONO, which is just its name minus the S. So Sonos is a home audio firm that specializes in wireless and multi-room sound systems. The company competes and is often compared against Bose. If any of you were watching Sunday Night Football last night, there was a big Sonos ad. So you could see Sonos ads starting to pop up more and more and more as they try to expand their market share, which we'll get to near the end. Sonos sells a range of sleek connected speakers and subwoofers and soundbars for TVs and much more, enabling people to build on their home audio collections either by buying in bulk as sets or, as I said, piece by piece by piece. Sonos speakers are sold as individually. They cost, and some of the sets can cost up to about $1,900. And the company has really thrived in a market that includes, as we mentioned, Bose, and also tech giants like Apple and Google as part of this broader home tech push. The company also sells architectural speakers, and sound systems that can be built into wherever you want in your house. And what the ad was that I mentioned last night on Sunday Night Football that returned last night was they have jumped into the connected smart portable speaker market, which is maybe its most broad mass appeal speaker. So that's the Wi-Fi and Bluetooth enabled Roam, which costs $169. And as I said, it's the most mass appeal speaker, and that was what they were advertising last night. So you could see that, hey, maybe help them grab even more market share going forward. The company also last November rolled out its new ad-free HD streaming tier of its radio service. The Sonos Radio HD costs $7.99 a month, so $8 a month, and it tries to compete against Spotify, Apple Music, Amazon, and all of these various other streaming music services. So in terms of the stock price, Sonos struggled after its 2018 IPO, but it took off from the market's coronavirus lows alongside countless other tech stocks and consumer businesses that succeeded during those rough conditions. And as more people work from home and as more people continue to work from home and value their space and their home life, you could see the speaker market continue to thrive. So Sonos jumped from around $9 in March 2020 to over $15 by October. Then it skyrocketed after it crushed our Q4 estimates last year and announced a new $50 million repurchase program at the time. The stock then was trading about 25% below its highs heading into its most recent report that saw top estimates, with revenue up 52% and its gross margin up 300 basis points to 47%. The company has also crushed our earnings estimates in the last 4 quarters. Last quarter, we called for a loss of 17 cents per share, an adjusted loss, and the company reported positive 27 cents per share. And then the quarter before that, we were calling for a 22 cents per share loss and reported positive 31 cents per share. So really strong bottom line beats recently. So looking ahead, Zach's estimates call for Sonos's 2021 revenue to surge about 30% to 1.7 billion, with 2022 set to then jump another 11.3% higher, which would come on top of 11% expansion in 2019 and 5% growth in 2020. On the bottom line, we're expected to see Sonos soar from an adjusted loss of 18 cents per share last year all the way up to positive $1.11 per share this year, with it then set to climb even higher than that in 2022. In terms of some of its recent price movement, the stock popped after its August 11th release and then soared again later that month after a U.S. trade judge found that Alphabet's Google infringes on 5 Sonos patents. That decision could shut down some of Google's smart home devices, phones, and laptops out of that key U.S. market. So more broadly, the stock is up 170% in the last year and 55% in 2021. Luckily for investors who might have missed out on that, it has cooled off since then. So it's over the last 6 months, it's down 15%, and it dipped another 2% on Monday morning to around $36 a share, which puts it around 20% below its record highs. The stock is also trading at around 29 times forward 12-month earnings, which puts it far below some of where it's been in 2021. So it's at its lowest levels of the year so far, or lowest levels since early February, based on the chart I'm looking at the moment. And the recent pullback has pushed it below neutral RSI levels of 50 at 42. Sonos also lands a Zacks ranked number 1 strong buy at the moment, alongside an A grade for growth and a B for momentum in our style score system. And like with Garmin, the speaker firm's balance sheet is really pretty solid with no debt on its books at the moment. Plus, CEO Patrick Spence is confident that Sonos will be able to capture more than its current approximately 9% share of the global, or 9% of the total spend in the $18 billion premium home audio market in the US. And obviously international expansion is the next logical growth sector after that. And then the CEO also pointed last quarter to 3 broader aspects of why he sees the company being able to grow for the longer haul. And he says one of them, the category, is the golden age of audio, as more and more of, as I mentioned, these premium home audio companies from Apple to Bose are able to offer these sleek, small devices that you can put all over your house and anywhere. And as people are spending more time from home, that's going to be able to grow. Secondly, the broader category is Hollywood at home. So as a lot of people probably know, even before COVID, many movie theaters were struggling with only those big blockbusters doing well at the movies. And COVID has just increased that to where most people are watching tons of movies and tons of entertainment at home. So that's another long-term growth tailwind for Sonos. And then the third is what he calls the great reshuffling, which is sort of what we've alluded to already, is that more and more people are slowly going to be at the office less, maybe spending more time at home, concerned about that maybe they had before not been spending enough time at home or with their family, and they're valuing more of their home life. So having home audio is certainly a positive on that front. So these are 2 stocks that are consumer focused tech stocks. Garmin maybe has a little more to the non-consumer focused side, but both are Zacks ranked number 1 strong buys at the moment. Both are sitting below their highs. They both have really strong balance sheets, and maybe you want to be taken as a longer term play for investors with, as I said, longer term horizons. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.